thank you very much, everybody, from joining. I'm looking forward to this conversation today. We have announced we have Russell Thompson on today. He's from his garden in the UK, and we are going to go into the macro environment for global assets, but in particular also for crypto and digital assets as a whole. So, thank you very much for joining, Russell. How are you today?
I'm very good, thank you, Søren. Nice to see you again. Last time we met was in Copenhagen, I think, just before Christmas.
It was Copenhagen 20, exactly. It was just before Christmas in 2024, doing the macro outlook for 2025. Congratulations with that. It was very popular, and you hit it spot on. It's still available, and that turned out to be a busy year, 2025. Also with I think volatility peaked quite early. I think it would be really helpful if you would give us your view. Us just as an introduction, of course, Russell Thompson is the Chief Investment Officer for Hilbert Group. He's also a macro strategist and has a long career in TradFi. The founder and Chief Investment Officer for the Cambridge Strategy Story, and later founder of Liberty Road Capital, and runs also your own family office, and then part of the Nasdaq listed company Hilbert Group today. So maybe you will give us a quick introduction to yourself, Russell, and your opinion on the current macro conditions.
Yeah, well, I first walked onto a trading floor when Soros took sterling out of the ERM. That's how old and grizzled I am. So I've been on trading floors since then. So nearly 40 years. I spent a lot of my career in Asia around trading for HSBC and for AIG Trading, and then founded my own hedge fund called Cambridge, which I sold to Mesirow Financial back in 2018. We got up to $3.5 billion in assets, and then I co-founded Liberty Road with a couple of my partners in Hilbert now. That was in around 2020. And then we came across Hilbert in 2024, and we merged with Hilbert in March of last year after about a 9-month process. So we sort of brought the alpha generation to the firm, the risk management. Hilbert, being a Nasdaq listed company, had all the infrastructure, all the in-house legal, the operations, the KYC. So it was a very good marriage where we could bring two sides which both sides needed. So and we spent about 6 months just putting everything together, getting the two companies acquainted, and we're in full execution mode at the moment for 2026.
Fantastic. And what is your main focus on right now? So you're a group of former TradFi operators that are leading Hilbert Group today. So what are the main asset management products that you offer?
Well, we have our flagship product is our Basis Plus. So we're known as being we're a crypto or a digital asset manager. Basis Plus is our main product. It's done very well. It's doing well this year. It did extremely well last year. We do have some more directional products. We have a multi-strat, and we actually have a global macro. But a lot of the stuff that we look at in terms of the trading decisions, the AI, the trade signaling, all fits within a global macro lens. And this is where I think a lot of people get Bitcoin wrong. The days of Bitcoin operating in a vacuum are long gone. This huge inflow of institutional capital that we've seen in the last 18 months with the ETFs means that I think this 4-year cycle is dead. I'm not a crypto maxi or a native guy. I have owned Bitcoin from 2014, but I'm not. I don't sit here praying to the Bitcoin gods. It's an asset class for me, and I'm happy to be short it or long it. I've got a small predilection that I'd like it to go up, but but I don't sit here worrying about that. So I look at the global macro lens and how Bitcoin fits into that, and then it sort of starts to make sense. I think if you're talking about on-chain data and whales and the 4-year cycle and stuff, I think you can get, you can get very confused and miss what the big picture is. So that's how we look at things. We look at things in a particular, what is going on in the world and how are those events going to impact the movement in the assets that we trade going forward. And the last one that we trade is we're the investment manager on Byzantium, which is a joint venture with Zappo Bank, and we have around about $500 million in assets in the entire firm.
So if we look at through a macro lens, so in a minute we can just go into the macro landscape and how we see it right now. But it's a dynamic process, and it had over the last 10 years changed a lot, which impulses have been relevant for the price development of Bitcoin. So I guess with institutional adoption, as you mentioned now, liquidity has changed. I would say we still have quite high volatility, but if we just look at the recent impulses here, we discussed it before we went on here. The RSI is the lowest level since 2020. Number just on Google search, etc., is declining, and the fear greed index is kind of the worst since, even worse than the FTX. So it has had a very tough year. I would say 9 months, but it seems to stabilize a bit. How do you see, if we just touch on the macro impulses that are relevant now? So how do you see that right now?
Well, I don't really look at Bitcoin in those terms, really. I look at it on a much broader spectrum. And so if you want to sort of unpick it, I think I wrote a paper a couple of months ago called The Liquidity Lie, which really quite clearly articulated why I believe Bitcoin fell from October and is still struggling. But I think maybe just before I get into that, and that's all down to liquidity. But before I get into that, I think there's one sort of very obvious point that like I make to people. People like they look at me as I'm an idiot, but the reality is that markets do not top or crash or fall or conversely bottom on valuation metrics. They just don't. So if you are looking at global market valuations, particularly equities, that's what everybody is worried about. And obviously there's a huge amount of debt out in the market, but we can talk about debt later. So the concerns that have been out there is that we're going to get a dramatic pullback in equities. And I do believe that there will be a reckoning, but valuation metrics are not enough to signal a top, and they never have been. It is always some form of exogenous shock that is related to liquidity and risk. And in terms of how I look at liquidity, I sort of would say it's almost the same thing as risk, because liquidity can lead to risk aversion, and risk aversion can lead to liquidity destruction. So the two things are like a horse and cart. And so I look at a number of things that like let me know or give me some insight into what is going on globally with liquidity, because liquidity at the end of the day drives global asset prices, and it always has done. And if you're going to say, well, look, valuations, who's to say that 2 trillion on SpaceX is expensive? Maybe it's cheap. Everyone that thinks every person that thinks it's expensive, there's going to be someone else that thinks it's cheap. The NASDAQ forward PE, we're at 27 at the moment. Trailing PE is at 35 on the NASDAQ. Is that expensive? Well, historically, yeah, it's expensive. Historically, trailing PE on the NASDAQ is low 20s, around 22. So We're way above historical levels of PE on trailing basis for the Nasdaq. That does not necessarily mean that Nasdaq PE ratios don't go to 45 or 55 or 85 or 105. The reality is that there will need to be a shock of some sort that will generate a movement in liquidity. And so what matters is both the overall global pool of liquidity and the movements within that pool. So if you think of the overall pool of liquidity of being like a big bucket, and you've got two buckets under it, one of them is the financial system and one of them is the real economy. And what you see time and time again is movements in the liquidity pools out of one and into the other bucket are almost always responsible for significant movements in asset prices. Now, Bitcoin's a very interesting one because it's super high beta and it is very sensitive to these liquidity flows because, and one very obvious reason for that is it's a periphery on the portfolios. So if someone gets risk averse, they will tend to, or they get margin called, they'll sell the periphery assets first, one of which will be Bitcoin. So what we need to monitor is how liquidity is moving within one sector, and that is essentially capital rotation, but also how it is moving from one sector to another. And if you look at what has happened since September, and mainly it started in October, is we have seen a significant movement in global liquidity. Both the liquidity pool has fallen, but there has been a very large movement out of the financial system and into the real economy. And one very obvious symptom of that everybody can see is Bitcoin falling and gold going up. Gold is a commodity, it sits in the real economy. Bitcoin is a financial commodity, sits in the financial economy. And that capital rotation out of the financial sector into the real economy is one of the major reasons why Bitcoin has fallen. It's very sensitive to these flows in liquidity. They started at the beginning of October, and almost literally, in the same week, we saw Bitcoin make a top, and there's never looked. It's fallen 50%, or more than 50% from there. So, and so how do I know that? How do I know that these flows are happening? Well, if you pay attention, you can see. There's a number of things that you can look at and say what is happening to liquidity flows and what is happening to risk aversion. And from that, you can say, where are we in the cycle? And that is where you start getting some predictive value from this whole process, because you can say, well, are we towards the end of that cycle? Have we just started? Will Bitcoin keep going? Has it bottomed? Are we going to see new highs? And so you can start to just look at the evidence. So what are the things that you need to look for? Risk appetite for safe assets, the risk premia is one thing. You can look at that. Now, the risk premia, 10-year risk premia, is not the 10-year yield on US Treasuries. If any financial professionals that are listening in will know that. It is the premium that an investor will pay to hold 10-year Treasuries over what the 10-year interest rate is expected to be over the next 10 years. As that goes up, that's a clear sign of risk aversion. When it goes down, it's a clear sign of people are not requiring that premium. And obviously during COVID, that we had negative risk premia. And since September, October of 2025, risk premia has climbed on 10-year risk premia quite considerably. There's a number of models you can use to do this. I look at the ACM model, but it's trading right now at about 0.6, which is not red flag flashing signals, but it has gone up quite considerably from negative numbers in 2025. So risk premia is something which you can pay attention to. Collateral volatility. Collateral volatility is a direct impact on liquidity because haircuts move. You know, investors or lenders want more collateral, higher quality collateral, and that you can see that has a direct impact on global liquidity, particularly in the financial markets. What's the best way of picking up on collateral volatility? It's the move. So we track the move. The move from October, November, December rose quite considerably. Now it's turning back down again. We're back at sort of very normal levels in the move, and so volatility in the US bond markets has normalized, but it's come off from 130, I think, move. It's down. It's around about half that now. It's at 65, but it had climbed to get there. Repo rates. What's going on with repo rates in the world? You know, and a really good way of looking at that is the SOFR and minus the IROB, which is basically the risk premium that people will pay in the repo market against the Fed funds risk-free rate. If you look at that, anyone that's got TradingView, if they want to like test me on this, go and put that formula into TradingView, and you will see in September and October, the first few weeks in October, that ratio went through the roof. That is direct evidence of liquidity declining in the financial sector and rotating out. So you know, you can track that. And then the last thing that I look at is emerging market flows. You know, they're a very good indicator of risk, you know, aversion, FDI flows. The IIF capital flows tracker is very good. And again, if we look at that, what happened 2025, second half of 2025, we fell dramatically in terms of flows. They went from positive 50 billion to negative 25 billion in capital flows going into emerging markets in the second half of 2025. They've now started to pick up again. They're now back positive, and we had a very, very big month in terms of inflows in May. And the other thing that is worth paying attention to is corporate funding costs. Again, directly impacted by liquidity. Corporate funding costs, which is a good way of looking at that, is what's the spread between single B and triple A corporate credit. That has gone from November of 2025, I think that was around about 120. That's now up at 150. So all of those things, we are seeing a movement of liquidity out of the financial sector into the real economy. And we're also seeing a contraction of global liquidity. And Bitcoin is at the very sharp end of that. And it comes up very quickly. A lot of people, a lot of research houses actually include the price of Bitcoin as a proactive measurement of risk aversion because it reacts so quickly. So liquidity is really, and it shows up in US treasuries, in yield spreads, flattening and steepening yield curves. And so right now, where are we in that process? You know, and this is not just relevant to Bitcoin, it's relative to global assets. And it looks like to me that sort of outflow of liquidity, particularly out of the financial sector, has stabilized, but it is not picking up yet. It's not picking up. So we are bottomed. We've probably made a bottom in that. There are certain things like emerging market FDI flows that have picked up quite strongly. The repo rates, the SOFR, IROB is back to zero. So that's sort of promising, but we're not yet seeing really big global liquidity creation that we're going to need to keep seeing, like to get Bitcoin back to new all-time highs, to push equities to new highs, get bond yields down. So we're in the middle, I think, of making a bottom, and so I would say that quite honestly we're in a bit of no man's land with global markets at the moment, and we're in sort of towards the bottom end of a rather large range. Sorry, that was quite a long explanation.
Yeah, no, but it's great to have a full view and understanding of your framework. Uh, Thank you for sharing that. I was just thinking, in terms of these impulses, if you also look at the AI cycle, and of course that has required a lot of capital flow going into to AI, both private market, public market, as of late as well. Um, there is still, yeah, a lot of volatility associated to that. Do you see it? Is that something you track as well?
I do. I know a lot of people that have put a lot of store in that. That there has been capital that's been sucked out of the crypto markets that's gone into the AI markets. I don't necessarily really believe that, to be honest, because if you look at and I'm going to include SpaceX in there and the you know the these floats are quite small numbers. They're not floating 100% of the business, but clearly there has been some capital rotation that's gone out of the more volatile financial assets, of which Bitcoin is one, as liquidity has started to dry up and has gone into other things. And of course, in that argument, valuation is important. People can say, well, my perception is that Bitcoin at 120,000 is quite overvalued, and that buying Meta has more sort of long and as Meta goes up, Bitcoin goes down, then the reverse argument applies. And I do think we're seeing a bit of that. We're seeing that capital rotation coming back into Bitcoin, which is why Bitcoin has actually done quite well in the last couple of weeks, despite we've had a sell-off in AI stocks in the last few days, and Bitcoin's done fine. It's up like 6-7%. So I think that is, but obviously, as I mentioned at the very beginning, the biggest capital rotation trade that's gone on has been gold. And that has been going not just since October, but central banks have been buying significant amounts of gold for years. But obviously, the geopolitical risks of where gold is concerned have helped underpin it. But I don't think, looking at liquidity, I don't think we're going to see new highs in gold. So, I think we're in a range.
I think there's a lot of asset classes that are kind of disconnected a bit from the macro movements. And I mean, now we see oil come off again, but interest rates are still up, and we're gonna have Fed coming out soon. We have a new chair. Any opinion here?
Yeah. Well, I think number one, he's on record that he believes that AI is disinflationary, and he's a big believer, as are most of the people on the Fed, in inflation expectations. CPI is a measure of past inflation. It's not particularly accurate anyway. They're very big believers in looking at the different metrics around inflation expectations. So number one, I do not think that this Fed is in hike mode. And I think that the next move in interest rates from this Fed will be lower. I think Walsh wants to cut rates, but I think he's more of an interest rate dove and a balance sheet hawk. So I think he's much happier cutting rates than he is engaging in any QE or anything like that. He's not a fan. So number one, I think that the market's got the Fed wrong. Number two, if you look at really what's going on in the markets, you look at 10-year inflation break-evens. They've fallen 30 basis points in June. They're at 2.2 now. We are going to get the University of Michigan inflation expectations around about this little window, which you want to talk to me about, which is in the middle of July. And that's going to be a very important number, because if inflation expectations keep coming down, then this Fed is going to be more inclined to cut. So I do not think that we have got an inflationary problem in the US. And I think that the data is going to play out. And we are going to have probably a risk rally once we start getting some of the data falling through in these inflation expectations. So that's the sort of the second point. I think the data will give the Fed the opportunity to cut. The market doesn't agree with me. That's fine. And thirdly, we've got the November midterms. So the heavy lifting does not all have to be done by the Fed. Besant has already said, and I won't really dive into this now, but it's in the article I wrote a few weeks ago. He's already said that he's going to reform the supplementary leverage ratio. That is going to be, they did that, if you remember, they did that over COVID, then they reinstated it back to how it was. But that is worth between 30 and 70 basis points of liquidity into the global system. So I think that Besant, as Treasury Secretary, will be doing something on the SLR. And also the US government has got the TGA. The TGA has been topped right back up again, and they could easily push fiscal stimulus into this US economy by drawing down onto the TGA. They're already doing the RMP, 40 billion of that. So there's the opportunity and the ability for this to be tackled from both sides, from the monetary side and from the fiscal side. And I think that that's where we're going to go. We're going to get a US government that will be pushing fiscal stimulus into the second half of the year, and as the inflation data gets better, a Fed that could potentially cut rates. Now, why would they do that? Why would the US? Well, we've got the November midterms. Trump wants to goose these markets into the November midterms. They're on very slim margins, and he can't afford to get widespread losses. So I think that's the policy going into November. So we're running out of time there. So I think that this year, the liquidity situation, from just looking what I said like 10 minutes ago, where we've bottomed, this liquidity destruction is probably over. We're going to start heading back up, and we're going to start seeing some of these things play out, with particularly the SLR, where the US government gets involved with actually providing some liquidity, primarily into the real economy. The TGA will put liquidity into the real economy, but the real economy liquidity will flow at some point back into the financial system.
So you're going to see, you expect we're going to have a strong end of 2026. Is that how I can interpret this?
I think it's more likely than not. I don't think that it's going to be. I don't think it's going to be rock star, because we need that. We're coming from a position where we've had liquidity destruction for 6 months, so that's going to start moving up. But the point I made at the very beginning is the fact that we are at 27 forward PE on the Nasdaq does not mean that that can't go up. So the fact that we've got high valuations, and in US equity markets, does not mean that they don't go higher. And I don't really see the catalyst that's out there for a very big exogenous shock, short of me being completely wrong and that being inflation. Because inflation picks up, and if you want to get the inverse argument here, if inflation picks up in the US, it's a big problem. It's a real big problem with the amount of, and I'm not going to go into debt GDP ratios and all that stuff. Everybody knows that there is a huge amount of debt that A, needs to be issued, and B, needs to get rolled. And if inflation does pick up meaningfully, that's going to be a real problem. And that will have real implications on the dollar, on US treasuries, and definitely on risk assets. So, inflation's the key one, I think. If you're looking for something that could be the trigger, the catalyst that could move the markets the other way, it'll be worsening inflation data. But I'm not in that camp.
Another point that has been a concern for digital asset ecosystem and investors in general is MicroStrategy or strategy. And obviously there was not long ago where strategy sold not many, but some Bitcoin, which was kind of at least a change of narrative, symbolic amount, but of course has a huge psychological impact on the market. Now there is also discussion on whether his high concentration is obligations for yield, paying yield on the financial products that he has issued. Where do you see this? Is it systemic um, risk that we are facing right now? Could it be that in the future, or I mean, it's highly debated, right? And he doesn't get the airtime that he used to, given where markets are. So how do you see that?
I think that strategy is a huge red herring, and it's very weird, this constant drumbeat on the uncollateralized or the unrealized losses on where they bought Bitcoin compared to where Bitcoin is now. Other companies are not valued that way. Strategy should not be valued that way, and it is ridiculous that this is the drumbeat and the metric that people are using to get worried about strategy. Look, strategy has got nearly 7 billion of convertibles. The average yield on those is 0.5%. It's got about 15 billion of perpetual preferreds. That's equity, but they do have a dividend obligation to them. Those dividends are anywhere between 9 and stretches now. They've just raised that to 12. So they've got 22, 23 billion of debt, and they've got $53 billion of assets. You know, this is a company that is massively well collateralized. If you go and compare the leveraged balance sheet of every company in the S&P 500, it will be in the top 10 in terms of how secure it is. It is massively over collateralized. He's also obviously just sold some Bitcoin, and this sort of, I'm never going to sell some Bitcoin. He doesn't do himself any favors. They bought back 1.5 billion of convertibles a couple of months ago, which was pointless. And he drew down his cash reserve, and the market didn't like that. I didn't like that, and I just thought it was pointless. Why would you take down some 0% convertibles and draw down $1.5 billion out of your cash reserves? So this whole selling of Bitcoin that they've been doing recently has been to put the US dollar cash reserves back into a better place. And they're sitting around 2.5 billion. So in terms of meeting his debt and dividend obligations, Strategy's got like 17, 18 months of runway. So it's nothing to worry about. It's got, if you were to assets, it's got like 40 years of coverage based on the overall Bitcoin asset pool, the 850,000 or 840,000 that they're holding. So it's a very well collateralized business. So this sort of that it's a systemic risk just does not ring true. We did some work on assuming that Strategy did nothing and they just sat on this Bitcoin and didn't sell anything on the way down, where would Bitcoin need to get to be a systemic risk, basically, that they would be in risk of going bankrupt? We're talking about 6,000 to 8,000 Bitcoin needs to be out, and that's assuming that Strategy does nothing. So I don't think it's systemic at all. There's this drumbeat out there about it. I think the market clearly has liked what he's done recently. That did entail selling Bitcoin, of course, but Stretch bounced from 72, I think it's at 88 or 89 now. So the price is sort of commensurate with a par of 100 of where the dividend yield is being paid again. And of course, he's always got the ability, should he want to sell more Bitcoin and buy these perpetual, preferred stocks back, or even buy the convertibles back. So I don't get this drumbeat about Strategy at all, and that doesn't worry me. And I'm not a Michael Saylor fan. I'm not, he does what he does. I think that it's quite strange that they don't actually try and generate yield on their own Bitcoin.
Ross, I mean, you and I, we have been in capital markets for 30 years. And we have seen when someone sits with a weak hand, the market tested. Do you think he's vulnerable for being tested by hedge funds and others? To
The falls,
no?
we're talking about a 90% fall from here. It's and it's not as if that will happen in a vacuum. And no matter what, at the moment he's got $2.5 billion of cash reserves. He's got 17, 18 months of coverage to pay dividends and interest on the convertibles. I don't think he's at risk at all.
So
He's
if you
clearly at
look
risk
at,
if Bitcoin keeps falling. If it keep going down and down and down, then the balance sheet is going to get more and more impaired because it's got one asset on it, which is Bitcoin. But right now, I don't see that scenario at all, and I'm not worried about strategy.
okay, fantastic. And would you prefer to buy the stock or buy the Bitcoin? I mean, obviously the stock has been trading with a premium, and it's certainly reduced significantly.
Yeah,
Where
I haven't looked recently. I think it might be a best at parity again. It might be a discount. Um, uh, you know, I've not really got a massive view on whether I'd own strategy or own Bitcoin. And I hear again the drumbeat: don't buy strategy. It's a Ponzi scheme. Just if you want to own Bitcoin, buy Bitcoin. You know, something to be said for that. You eliminate and remove a lot of the unknowables. I just don't think that there is a risk there, and in all likelihood, when Bitcoin recovers, the NAV premium will reassert itself on strategy, and it'll outperform Bitcoin on the way up.
yeah. So of course there's yeah, market movements and expectations here, but there's also politics and policies. The Clarity Act has been ongoing for a long time. It seems like it's been between Jamie Dimon and Coinbase for some time with some rounds. What do you expect to come out of this? I mean, it looks like it's going to be fought hard from both sides, and politicians has been reluctant to really step in.
So here is the timeline and the basic facts of what's going to happen with Clarity. So the the Senate comes back from its recess on July 13th. There is the House Committee on Financial Services. I've got Walsh doing his semi-annual review. That's going to be a big day. We're going to really get to hear from Walsh in terms of what his views are with what's going on in the US economy on that day. And then the next day after that, we've got CPI on the 14th, and then we've got PPI on the 15th, retail sales on the 16th. And then we've got the field hearing on Clarity on the 17th. Now, the date that is being shot for here is August the 7th. So for Clarity to get through, it needs to get 60 votes in the Senate, right? The Senate at the moment is split 53 Republicans who will all vote for Clarity. There's 45 Democrats and there's 2 independents. Those 2 independents will vote with the Democrats and they will not vote for Clarity. So at the moment, for Clarity to have any chance, it has to win 7 votes from the Democrats to avoid a filibuster.
Yeah.
There are 2 guaranteed votes from the Democrats. Also, Brooks, who sponsored the House committee bill, and he voted for it on the committee, and Gallego, who also voted for it on the committee. So we're at 55. So we need 5 Democrats to support the Clarity to get this through. There are 12 Democrats that are they're either strongly supportive or supportive of crypto. Now, there are a number of issues. I won't go into them in terms of some of the different parts of the bill which they're haggling over. But basically, there are at least 3 or 4 of those strongly supportive that are highly likely to vote for clarity. So really, what you're looking at here is to get 1 or 2 out of the remaining 8 that will vote for clarity. None of the other Democrats, they're going to go with Warren. None of them will vote for it. So you've got this little group in the middle, which are going to decide the fate of clarity. And if they can get 5 votes out of these sort of 12 that are strongly supportive of crypto, and they can get a deal done with them on some of the parts of the act that they don't like, then it will go into law. So that's what the bet is. It has to get done by August 7th, because then we're going to go into the November midterms. So there's a 3-week window here. We're going to know. Now, it could be, bearing in mind everything I've said on liquidity, and I think we're in a range, but it could be a catalyst to drive Bitcoin up it will be a catalyst to drive Bitcoin up if that were to happen. There's a good website which people can look at, which is called Stand with Crypto, and you can go through and see how all of the different Senate members are leaning. It's quite interesting to go and to go and track this. And so, and if you look at Polymarket, Polymarket was down at around 40% in terms of chances that it passed. Up until the beginning of this week, I think we were at 55%. So it was one of the reasons why Bitcoin has rallied in the last few days. It's dropped off again today. We're back down at 47%. I think personally, we are much more likely than 47% to get clarity through. Okay. I think that they will cut a deal with at least 5 of these Democrats who will support this bill, and that's what they need. And and there'll be no time to mess around here, and Trump will have to sign this into law August the 7th. So that is the timeline, really. One thing that did help sentiment on clarity was the county sheriffs came to an agreement. So law enforcement basically have gone neutral rather than negative on clarity. So they got some reassurance from the Republicans that certain acts of the bill would protect, the things that they were worried about regarding law enforcement. So they've gone neutral on that, which is one of the reasons why clarity is that the odds have jumped like quite so much. But as I say, I think you're looking at 5, and I think at least 3 of those 5 are pretty much done. So you're looking for 2 Democrats to cross the aisle.
It's going to be exciting. What do you think market impact will be?
I think it'll be positive. Depends on where we are. We've bounced here from sub 60, 58, 59. If the market expectation is that this is going to get passed, and we are sitting at 68 by the time it goes through, the impact will be probably quite muted. It's not going to be a catalyst that's going to drive us to new highs in Bitcoin or break us out of these ranges. The top of the range here, 75, maybe 80. But it would be certainly positive. It will be the downside is much worse, because if this doesn't get done, then the Republicans are going to lose seats in November. It's the midterms. The sitting government always does. It could be better than they think. It could be worse, but it probably means that this thing doesn't get passed under the Trump administration, and we're going to be, then all bets are off into a new election. So, the downside on not getting clarity done, I think is quite bad. So I think Bitcoin would not like it if it didn't pass.
We would probably see some new lows. I mean, chart wise, it hasn't looked convincing either. But Søren, I mean, we are also at the World Cup series, and when we announced the conversation today, you were boldly out on LinkedIn predicting that the UK would win the following 2 games.
Not the UK, Søren, it's England.
It's England, sorry. Um,
Don't mix us up with the Scots or the Welsh.
My feeling is they don't want to be mixed up either. So I think it's very, very fair. So it's England. Played very well. You're meeting our little brothers or brothers, Norway next time. How do you feel about it?
I think we've got a better team. I think we'll beat them. But like Erling Haaland is amazing. You know, absolutely. What a player he is, and you know we need to be able to manage him. If we can manage him, I think that this team has got the mentality to beat Norway. I don't, to be honest, really rate Argentina either. I know everyone's raving about their second favourites and what have you, but I think that we could definitely beat Argentina, assuming that it is Argentina that we get. And then probably a France or Spain final. And I'm not so keen on that. I've got to say, Spain haven't conceded a goal yet, and France look very good. And again, Mbappe, what a player he is, you know. And that match against Paraguay, what a disgrace. I thought that he kept his temper and kept himself, you know, he did a very, very good job in very trying circumstances. So
Absolutely.
yes, I think that we've got every chance of reaching the final, and I'm confident that we will beat Norway. But it's going to be a tough game. They are a very good side, and they've really got momentum, haven't they? They're on a roll. So
Yeah. No, I think it. Yeah, they have a very strong midfield, very strong attack. So, and the goalkeeper, I mean, out of nowhere, has been really, really impressive for Norway as well. So it's going to be an exciting game, I'm sure.
it will be. It will be. Cap Verde has been the real that they have been just brilliant. That goalkeeper and his mum flying in. Um, you know, I
And
think he's
his
got 20
15 million
million followers
followers.
overnight or something. They were a brilliant story. Such a
Absolutely.
shame. That equalising goal against Argentina was amazing.
I would say it's in my recent memory, it's one of the best World Cups I've seen. The strikers has been excellent. All the large big names has really delivered. Maybe not for Spain, but otherwise, we have seen the Mbappe, the Erling Haaland, and Kane, of course. Um, and I think the quality of the goals has also been really, really impressive for also the small teams. I've really been impressed about this World Cup.
No, it has
Obviously,
been it has been good. I really really enjoyed it, and obviously it's helped by the fact I went to Rio for the Brazil World Cup, and England got knocked out in the groups there.
yeah,
So it always helps when you've got a home team there that's actually playing well, and we've I think we got a little bit people got a little pessimistic on England because Panama was difficult because they played 11 men behind the ball.
yeah.
It was Congo was the same. So I think that I think we showed what this team has really got in them in the second half against Croatia and in that game against Mexico. And make no mistake, Mexico were a good team. And that atmosphere, I had a couple of
Yeah,
friends
that
that were
was
there.
incredible.
It was meant to be absolutely incredible, that atmosphere.
I'm trying to see here, Ross, if we have some questions. There's one here. How does the yield on Bitcoin work when owners can still have their coins parked in, for example, Coinbase?
So a lot of exchanges now support, and Deribit is one. They support delegated coins. So you can use Coinbase custody, you can use Copper, you can use Anchorage, Falconex, Fireblocks, all of these different means of delegating virtual coins onto an exchange. So
Okay.
don't have that counterparty risk with the exchange. So you get daily settlement. So an investor would say, okay, well, I want to put my Bitcoin and I want to get the yield that you generate for it. It would come into our fund and they would be held offline in a cold wallet, depending on which custodian we were using. And then they would delegate those virtual coins onto the exchange and we would trade them as if they were real real coins, but they wouldn't be subject to hack risk or counterparty risk.
Okay, fantastic. Thank you very much for that question. I don't know. There's another one here. What's your view on digital assets like crypto, ETFs, ETNs, and tokenized product like bonds in terms of their future? Do you see growth in this product segment?
Okay.
That's from Yan.
Yeah. Look, I'm not the best person to ask on this because I'm not the biggest fan of tokenized products. Um, I don't see the point of a token where I own SpaceX. I can buy SpaceX. So, and this is the problem with a lot of things in the crypto world, and with a lot of layer ones and a lot of layer twos and a lot of these altcoins, is they're trying to solve problems that have already been solved. Now, tokenized assets are much cheaper, to be honest, and more efficient. So you can transfer, US stable coins in seconds from one counterparty to another. So they're more efficient, but they're not going to like change the world in terms of the that where some of the blockchain technology within things like insurance can be such a big game changer. So I don't like tokenized products per se if they're looking to solve a problem that's already been solved. But we are going that way. There's no doubt about it. Binance have just launched a load of tokenized products. ETFs and ETNs are going to be tokenized, and where it is very valuable is for the crypto natives. The foundations. We have a. I can't really. There's a press release coming on this, so I can't say anything now. But there's a press release I believe will be this week. But we have a strategy called Synthetica, which we've built, which is allowing people to put their Bitcoin on chain into our products. So it never leaves and that's quite valuable for a lot of people. You don't have any tax implications. You just basically move, you keep ownership of your coins, and you get your dividend yield on chain through a vault. So that's valuable, and getting access to products that are not necessarily so like VC. I like that as a tokenized product. One thing about I've stopped investing in VC about 5 years ago because everybody pivots and you can't get out and there's no liquidity, and then you're stuck with the founding team that decide to do something completely different. And if you could actually find a means of tokenizing those types of things, so you've got some liquidity, you take a haircut to get out, then that's solving a real world problem. So I like that. So some of the applications.
You could also see some synthetic product, right? I mean, as you said, you can buy SpaceX because it's public now. But there could be others. And not everybody who has access to that either, right? I mean, it's a so I could see that. I think in the U.S. alone, there's 50 million people that has crypto accounts, right? So I could see products, as you mentioned, could be venture, some private markets, and others where you can maybe make almost a tracker of certain product that would be valuable. But yeah, it's coming. We're going to be flooded with products. It's going to be exciting.
It is coming. The one, and this sort of goes back to tokenization. It goes back to clarity, and it goes back to basic economic theory. One last point I would leave you with here is that clarity is bringing some systemic risk here, and the reason it is that, and this is why the banks have been so concerned, and quite honestly, rightly so, is that there is the banks are the engine room of the global economy, and the Fisher's quantity theory of money is that the velocity of money is very important in the creation of economic activity. MV equals PT and inflation. And the impact and the follow through of liquidity creation sits within the banks, and the multiplier effect, when you go and put money into your bank account, the bank will then use a 10, 12, 14x typically. They will then use those assets, and that will be multiplied in terms of its economic impact into the economy. Now, there is a clear problem if crypto stablecoins, Circle, Tether, etc., are able to just play interest, because you will start getting money that will come out of bank accounts and will go into US stablecoins. Now, these are asset backed. There's no multiplier effect. Now, there are ways of DeFi and borrowing against them, but it's by nowhere near the same economic impact. And so that is something to be very aware of, that if Clarity were to go through as it is, or as it was originally, mooted, then there is a real risk that you get a flight of capital out of the banking system into, and nobody knows what impact that will have, but it certainly could happen, and it would probably have an impact on economic GDP and credit creation. So that's why there's been such a focus on, should these stable coins be able to pay interest or not? And there's sort of the compromise that seems to have come out of it is there's going to be sort of some fee structure, so you'll get something, but it's not going to be an interest payment. But anyone that owns US stable coins, obviously I do, they're super convenient, in terms of making a payment to someone. It's very, very easy to move capital around utilizing these things. Maybe not so much in Europe with the current European regulations, but certainly in the rest of the world.
No, but that's definitely the direction it's taking. I think we have quite a few questions, but we also passed the 1 hour mark. It's always such a pleasure to speak with you, Russell, and I would still have plenty of questions for you. I'm looking forward to welcome you back, and we always stay in touch. And I really appreciate you sharing your views and candid opinion on markets. So please.
Well, I'll be back in Stockholm and probably Copenhagen over the summer. So yeah, we can.
You let me know. You definitely let me know when you pass by next time, and if I pass by the UK, I'll come and see you for a drink in your lovely garden there.
Well, I'm going to Monaco tomorrow.
Have a safe trip. I'm sure it's going to be nice and warm down there as well. Thank you, everybody, for joining today. If you have any questions that you would like to ask Russell, please feel free to reach out to him directly. You can do that via LinkedIn or to Hilbert Group. You can find them online as well. If you have questions related to Hilbert Group and their financial services, also feel free to reach out to me or to the head of sales, Anna. And we will gladly share information on that. But thank you very much for today. Enjoy the evening, and good luck at the World Cup, Russell.
See you soon. Bye-bye.
Bye-bye.